Everyone in this industry follows one rule. You buy the factory after the orders justify it. Novo chose the opposite and paid $11 billion. It bought 3 plants that fill syringes before it needed them. Filling a syringe is the least glamorous step in pharma, and the one that decides whether a drug ships. Catalent, the seller, was worth $16.5 billion. 2/3 of it for 3 sites. Demand for their obesity drug had outrun the one-input, no-check buys: sterile filling capacity. They had already met this constraint once. Through 2021 and into 2022, supply of that same obesity drug was limited, not by demand and not by anything on Novo's own balance sheet, but by the pace of an outside plant filling the pens. The launch moved at someone else's schedule. Now read the asset list: Anagni, Bloomington, and Brussels. One of the plants that had been filling their pens. They didn't buy capacity in the abstract. They bought the step they'd been renting. Most public companies can't make that choice, not for lack of nerve, but because of who owns them. A chief executive answering to quarterly holders buys capacity when the order book justifies it, the allocation that survives the call. Lars Fruergaard Jorgensen answers to something else. Start with 2 numbers on the ownership line. Normally, they move together. Buy a quarter of a company, get a quarter of the say. Not here. A foundation-controlled holding company owns 28% of the capital and 77% of the votes. Control is decoupled from the money. The owner can't be voted out by a bad year. That's the ownership number. The second line item is what it cost. $11 billion on filling lines is $11 billion not spent on the pipeline, the slower, costlier road when they could have licensed capacity from someone who already had it. So what made the difference? It wasn't culture, and it wasn't vision. It's a voting structure that changes which decisions are survivable. The holders who'd punish a bad quarter can't outvote the ones who won't. It lands in the accounts. Capital spending moved from 47.2 billion kroner to 60.1. Here's what that actually means. They didn't just buy the plants, they committed to running them. Now the part that travels. The $11 billion did not buy factories. It bought a date. The moment Novo could supply the market, moved up by years. And the queue can't be expanded. A filling line is constrained not by steel or money, but by qualification. The regulator inspects the specific line for the specific product, and that approval doesn't transfer. So the scarce thing was never manufacturing. It was certified manufacturing. And there is a fixed amount of it at any moment. You can check this on any company, in an earnings call. When a company announces an acquisition meant to secure capacity, look for the capital expenditure line. Same period. Both moving means they intend to operate it. Flat Capex means they hedged. The capacity won't arrive when promised. One without the other is a press release. Run it on your board's last investment. Did the spending follow? If not, they didn't commit. They optioned. Before next year is out, someone here announces capacity that arrives late because the certified lines were already taken. The asset register says factories. The decision was a calendar. Every ledger in this industry now carries that entry. Novo's books show 3 factories. Everyone else's show a date they can't buy at any price.